If you're thinking about buying a home right now, you probably have heard very different opinions about the housing market. Some say it's a terrible time to buy. Others are predicting that home prices will continue to rise. And some are predicting that we are headed to a housing crash. Instead of focusing on the opinions today, I want to walk you through the actual numbers that economists use to understand the housing market and what those numbers really mean to potential buyers. Hi, I'm Amy Pierce with Keller Williams Arizona Living Realty, and I help clients relocate, buy second homes, and sell right here in Bullhead City and the surrounding areas of Mohave County, Arizona. In this video, I am going to break down 5 important things that the numbers reveal about today's housing market, especially for potential buyers. We'll look at how today compares to historical trends, what is driving the current market conditions, and why interest rates play such a large role right now. My goal is to help you understand the market from a broader perspective so that you can make informed decisions instead of reacting to short-term headlines. The first number to understand is home sales. Historically, the United States housing market averages roughly 5 to 5.5 million home sales each year. And that level of activity has been fairly consistent across decades and represents what economists consider a normal pace for the housing market. Over the past couple of years, however, the home sales have dropped closer to the low 4 million range. And that means that the market is currently operating below the historical average in terms of transactions. But that doesn't mean that people suddenly stopped wanting to buy a home. Typically, when the sales drop below the normal levels, it's because something is temporarily limiting buyers' ability to move forward. In the current market, the biggest factor slowing the activity right now are the mortgage rates. Higher borrowing costs have caused many buyers to just pause and reevaluate their timing. But historically, when the sales slow because of financial conditions rather than the lack of demand, it often creates something economists refer to as the pent-up demand. Buyers wait and they don't disappear. When conditions change or the buyers adjust to the new environment, those buyers often return to the market. The second important number to understand is where home prices sit compared to long-term historical trends. Over several decades, home values in the United States have increased to an average pace of about 4% per year. And that long-term trend is often used by economists to measure whether prices are growing faster or slower than normal. Right now, national home prices are still roughly 20% above the long-term trend line. And that doesn't necessarily mean that prices are about to fall dramatically, but it does tell us that the housing boom between 2020 and 22 accelerated faster than usual. And during that period, extremely low interest rates combined with strong demand pushed home prices upward very quickly. Since then, the market has been adjusting. Instead of continuing that usual rapid pace, price growth has slowed and begun stabilizing. This type of normalization is something we often see after periods of unusual strong appreciation. The third thing that buyers should understand is just how unusual the last few years were in housing. When you study the historical appreciation cycles, most periods of price growth within a relatively predictable range. But with the pandemic, the housing surge stands out as one of the fastest periods of appreciation in modern real estate history. In many markets across the country, home prices were rising 15 to 20% annually during those years. That type of growth is extremely rare. And when you compare it to other cycles, such as the housing boom in the early 2000s or earlier economic periods, the pandemic surge was unusually strong. After every major surge like that, the housing market eventually moves into a phase of slower growth and stabilization. That is exactly what we're in today and what we're seeing. The market is not collapsing. Instead, it is transitioning back towards a typical pattern after a very unusual period of rapid appreciation. At this point, I'm curious about something. When you look at the housing market right now, what concerns you the most? Is it the interest rate, the pricing? When is the right time to buy? Let me know in the comments below because those are the questions I'd like to answer in my future videos. Now, let's talk about the number influencing the housing market more than anything else right now, and that's the interest mortgage rate. During the pandemic years, the mortgage rates dropped to around 3%. Those were extremely low borrowing costs, and they dramatically increased affordability and brought a surge of buyers into the market. When the rates moved up into 6 and 7%, affordability changed very quickly, and many buyers decided to pause their plans. However, it's important to keep something in mind and in perspective. Historically speaking, today's mortgage rates at the low 6% are not unusually high. If you look back to the 1990s and the early 2000s, mortgage rates were often higher than what we see today. What makes the current market feel different is how quickly we moved from historical lows into a more normalized level. Buyers became accustomed to extremely low borrowing costs, so this adjustment has taken some time. But historically, buyers eventually adapt to a new rate environment and demand begins to return. The fifth number buyers should understand is the housing inventory number, which simply refers to how many homes are currently available for sale. Even though the market has slowed somewhat over the past couple of years, housing supply in many areas is still relatively limited compared to historical averages. One of the main reasons for this is something economists refer to as the lock-in effect. Millions of homeowners currently have mortgage rates around the 3 to 4%. Because of that, many homeowners are reluctant to sell and take on a new mortgage rate at a higher level. As a result, fewer homes are coming onto the market than we would normally see. When supply stays limited while demand still exists, it tends to support home prices over time. This is one of the key reasons we have not seen a widespread price decline in most markets. Now, one of the important things to remember is that while national numbers help us understand the overall direction of the housing market, real estate is always local. What is happening nationally doesn't always reflect what's happening in a specific community. When you look at an area like mine in Bullhead City and its market, we see some differences from those national trends. Demand here remains relatively steady because of the attraction of a large number of relocation buyers, retirees, second homeowners who are drawn to the Colorado River lifestyle and affordability compared to larger metropolitan areas. But when you step back and look at the bigger picture, the housing market becomes much easier to understand. Home sales are currently below the normal levels, largely because of mortgage rates. Prices are still above long-term trends after the pandemic boom, but are stabilizing. Interest rates remain the biggest factor influencing buyer activity today, and housing inventory continues to be limited in many markets. Understanding these trends is important because real estate decisions should be based on long-term perspective rather than short-term headlines. Every buyer situation is different, and the right time to purchase often depends on your goals, your finances, and your timeline rather than trying to perfectly predict the market. If you're considering buying a home, relocating to this area, or even just exploring your options, go ahead and scan the QR code or click the link in the comments below and book a call with me. And don't forget to like, subscribe, and ring the bell so that you don't miss any of my weekly videos about life here in Bullhead City and along the Colorado River. Thank you so much for watching, and I will see you next week.